Let me tell you one example how investors and traders are actually deluding themselves and grossly underestimating their risks and overestimating their performance. Well, that is simply nothing more, nothing less than but wrong approach to diversification. And I will show you 3 striking examples how it happens in real life. Fourth example will be with crypto coins and crypto markets in general. Here many investors and traders believe that they have been widely diversified because they have done research to various coins and think that those coins have different projects beneath them, and each of them will somehow change the world of financial markets as we know it. But here's the rub. In reality, all these coins correlate between themselves pretty heavily, and if crypto markets are hot, everything is hot, and if crypto crash, everything crashes together. So you are effectively betting on one market which correlates pretty heavily and has huge volatility. The volatility which is many multiple times higher than stock market or any other major mature market. So if you have your fortunes tied into crypto markets, you are not diversifying, you are just increasing risk while thinking you have decreased that risk. And that's very dangerous, as you probably might see now into summer at 2022. Now, let's not bash only crypto traders and investors and look at broader number of markets, and let's go to stock market. Here principle is quite similar. As you know, stock traders and stock investors are tying their fortunes to prospects of respective stock, but here also the reality is that most of the stocks are actually not performing that well, because S&P 500 shows the very best stocks, and you have heard for about like 2% of the stocks which has best performance, but in reality I think majority of stocks don't even reach more than 100% gains in their lifetime. But nevertheless, people are investing most of their liquid fortunes into stock market, doing wide amounts of diversification, look at different balance sheets, business models and whatnot. But here's also the truth. When stock market is doing swell, stocks are doing good. But if stock market is crashing, absolute majority of stocks are crashing together. So, like it or not, every stock trader and investor has his fortune glued to fortunes of stock market. And if stock market wouldn't do nothing for 10 years, so as your portfolio won't. Now, stocks might have some intrinsic value in terms of assets. Furnace, I don't know, plants, factories, apartments, inventories, goodwill and whatnot, but it only gives you real value once those assets are liquidated. Other than that, it's perception of their ability to make money in future. And that's very subjective, because look how the fortunes and not fortunes but market caps of company might change even into 52-week time period. It might be even more than 100% difference, although the real fundamentals haven't changed at all. But of course, that's a different subject, and I will talk about that another time. I will show you that just to give my point. And let's move on to third, I would say closer to physical world approach, and that would be real estate. Here also, like it or not, every real estate investor has tied his fortune to overall market and performance of real estate itself. Because when real estate is hot, lenders are eager to finance real estate deals, and investors and traders, here they will be probably called speculators, are eager to flip and buy and sell those real estates once they have opportunity to make money. But if real estate market in some region freezes, in that instances almost every real estate investor will suffer. So, like it or not, in some ways your fortune is tied to ebbs and flows of any market you make. Now in real estate, usually the time frames are much larger, and you could hold your real estate for 35 years and only receive cash flow from your rents. So a speculative element surely is a lot smaller than it is in crypto coins, but still, I'll just show you that to give you a point. If you are exposed to one asset class, you're exposed to one asset class. You have to remember that you are not special, and you have to consider these fortunes of that market, or namely asset class. If you don't do that, you are making a big risk. Well, you could accept that risk. You could accept that and say, yes, I will tie my fortune to one asset class and I will prosper if that asset class will prosper. That's fine for me, but you have to at least acknowledge that and plan your strategies accordingly. You cannot delude yourself. That's my point, and that's what I want you to hear. Now, excuse me, that is the key I want for you to say. Don't delude yourself. Understand realities and probabilities. And if you do that, doesn't matter how many asset classes are you trading and to how many markets you are exposed to. You will be fine if you understand that. So, are there any other real recommendations? Well, no, because there is no magic formula and there will be always uncertainties and risks. No matter how well or how bad you are diversified, anything might happen, at least in short term, and you cannot fully prepare for anything. There might be always something that might occur which you haven't thought about. You know, that's life, that's reality, but at least be aware that something might happen and do not lie to yourself. I made this statement for like 3 times in this video, but still, I think it's important and I wouldn't be overstressing my idea here. So, I hope I gave you a good lesson here today. And if you like what you see, you know what to do. Follow me on my social media and check out my links in my bio. So stay tuned till next video. Bye.